Good morning everyone, my name is Adriano Donati and I am the Head of Investor Relations of the Unipol Group. Today I'm going to take you through our preliminary results of 2021, the last year of our 3-year strategic plan. Our Group CEO will comment on the outcome of 2019-2021 plan during the conference call scheduled today at noon. Let's look at last year's results. Unipol pre-tax profit stood at 951 million, of which 821 in non-life, 213 in life and minus 83 in the other sectors. The consolidated net result was 796 million, that is 627 net of minorities. At UnipolSai, profit before tax was 895 million, consolidated net result 723 and profit net of minorities amounted to 688. These results, that are in the range between 2019 and 2020, allowed us to exceed the planned targets and are influenced by a particularly prudential approach whose insights will be further disclosed in my presentation. Non-life premiums grew by 0.8% at 7.9 billion. While motor premiums decreased by 3.7%, basically due to the average premium drop, non-motor premiums recorded a growth of 5.3%, thanks to the excellent performance of property and welfare lines. Worth mentioning is the trend of Unisalute, up by 7.5%, and of the bancassurance business, where Arca Assicurazioni increased its collection by 35%, and Incontra by around 30% year-on-year. Moving on to the non-life technical trend, the 2021 combined ratio stood at 95% net of reinsurance, thus bringing the 3-year plan average level to 92.1%. Combined ratio of the direct business was instead 92.5%, bringing the 3-year average figures to 90.6%. The total reserves release for 2021 was 336 million, that is around 40% less than 2020 and 2019 figures. This had a notable impact on the combined ratio. In particular, in the fourth quarter 2021, there were only 18 million compared to 278 million in 2020 and 212 in 2019, thus proving the very prudent approach adopted in the last quarter. At UnipolSai SPA in particular, motor TPL combined ratio of direct business was 95.6%, in line with 2019, which is more comparable in terms of mobility. The motor TPL average premium decreased by 2.8%, still affected by the market competition, while frequency, albeit on a good level, grew by 50 basis points over 2020 year-end. Good results came from Unipol Rental, the company of the group operating in the long-term rental business. Its net result was 15 million and the total number of registered vehicles increased to more than 14,000 units. Going back to the insurance area, life income increased by 24.4% to 5.4 billion. Arca Vita continued to perform very well, benefiting from the extended sales network and showing a triple-digit growth. The group continued to focus its distribution on hybrid products, as clearly demonstrated by the 115% growth in the unit-linked policies. The average segregated accounts yield was 2.92%, whereas the minimum guarantee was slightly below 1%. The yield retained by the group stood at 92 basis points, slightly increasing year-on-year. The weight of technical reserves with 0% guarantee kept on rising to 44% of the total amount. The present value of future profit margin amounted to 3%, arising from new business value equal to 88 million and the present value of new business premiums of 2.9 billion. Total assets amounted to 61 billion, with Italian govies settled at 39.1% of the total. The weight of corporate bonds increased to 29% of the total, while non-Italian govies accounted for 14.6%. Equity and alternative investments increased significantly compared to 2020 year-end, although the absolute amount of these asset classes remained quite low. The duration of assets was 6.1 years and that of liabilities 7.2 years. Moving on to financial yields, the overall return stood at 3.1%, of which 3.2 in non-life and 3.1 in life. The total running yield, made up of coupons and dividends, remained solid at 2.9%. The book value of the real estate portfolio was 4 billion, of which 59% allocated to the real estate accounting sector, 29% to non-life and 12% to the other accounting sectors. The total yield of the real estate investment portfolio, or third parties, grew to 4%. Last year, UnipolRec reduced its gross loans by 356 million. Since 2018, when the company was set up and started business, the cumulative GBV reduction has amounted to 1,452. In 2021, collections were 82 million, reaching a total amount of 404 million in 4 years. Net bad loans stood at 357 million, well covered at 87%. At our shareholders' meeting in April, we propose a dividend distribution of 30 cents for Unipol, that is 2 cents more than in the previous year, and 19 cents for UnipolSai, unchanged. These DPS are consistent with a payout of 64% for Unipol and 83% for UnipolSai. It is also remarkable that the annual average dividend in the last 3 years grew by 59% at Unipol and 24% at UnipolSai, compared to 2018. Solvency remained at excellent levels, that is 216% for Unipol consolidated, 286% for UnipolSai consolidated, and 331% for UnipolSai solo. I remind you that these ratios have already factored in the total dividends that the companies are going to distribute in May. Looking at the Solvency II components, Unipol own funds amounted to 9.7 billion, of which 7.4 billion were Tier 1, while the solvency capital requirements were 4.5 billion. UnipolSai consolidated own funds were 9.9 billion, with Tier 1 for 9.2 billion, while solvency capital requirements amounted to 3.4 billion. I'll conclude my presentation here. Let me remind you that the Group CEO and the General Manager will be pleased to take any questions from financial analysts and institutional investors during the conference call scheduled today at noon Italian time. Thank you for listening.